That car payment, the one that hits your account every single month, you know the exact number, $587, maybe $624. You signed for it at the dealership because the monthly amount felt manageable. But here is what nobody explained to you that day. The monthly payment was never the real cost of your car. It was designed to hide the real cost. And once you see the actual numbers, you will understand why you have felt financially stuck for years. That payment is not building you anything. It is quietly draining the one thing you cannot get back. Think back to the day you bought your car. You walked in with a budget. Maybe you told yourself $30,000 max. But the salesperson did not talk about the total price for long. They shifted the conversation. What monthly payment works for you? That question changed everything. Because once you started thinking in monthly payments, the total price disappeared. A $35,000 car suddenly felt affordable at $587 a month. A $40,000 car felt possible at $649. The dealership knows this. They have been trained on it. According to Edmunds, the average new car loan in America is now over $40,000. The average loan term is 68 months. That is almost 6 years of payments, and the average interest rate for someone with fair credit, 9.5%. But you were never shown what those three numbers do when they work together. The sticker price, the term length, the interest rate. Each one alone seems fine. Together, they create a trap that keeps you paying far more than you ever agreed to. Here is how car loan interest actually works. And this is the part they never explain at the dealership. Your loan is not split evenly between what you owe and what the bank charges you. It is front-loaded. That means in the first year of your car loan, most of your payment is going to interest, not to paying off the car. Say you have a $35,000 loan at 9.5% interest over 72 months. Your monthly payment is about $624. In month 1, $277 of that $624 goes straight to interest. Only $347 actually reduces what you owe. You paid $624, but the car company only credited you $347. That is 44% of your payment going to the bank, not to your car, and it stays like that for a long time. After 12 full months of payments, you have paid $7,488 total. But your remaining balance is not $27,512. It is $30,904. You paid $7,488 and only knocked off about $4,096 from the loan. The other $3,392 went to the lender. Now here is where it gets worse. Your car is also losing value at the same time. According to AAA, a new car loses roughly 20% of its value in the first year alone. So that $35,000 car is now worth about $28,000. But you still owe $30,904. You owe more than the car is worth. This is called being underwater. And it happens to millions of car buyers in the first 2 years of their loan. You are not bad with money. The math was designed this way. Now let us look at the full picture, because this is the part that changes how you see car loans forever. You bought a $35,000 car. Your interest rate is 9.5%. Your loan term is 72 months. Your monthly payment is $624. Let us do the math together. $624 times 72 months. That equals $44,928. But wait, you also put $2,000 down at the dealership. So your total out-of-pocket cost for this car is $46,928. You paid $46,928 for a $35,000 car. That is $11,928 in interest alone. But we are not done. You also paid taxes and fees at the dealership. The average sales tax and documentation fees add roughly $2,700 on a $35,000 vehicle. So your real total is closer to $49,628. Now, where is your car after 6 years of payments? According to IC Cars, the average car retains about 31% of its value after 6 years. 31% of $35,000 is $10,850. You spent $49,628. You now own something worth $10,850. The gap is $38,778. Gone. And here is the sentence worth remembering. A $35,000 car loan at 9.5% interest over 72 months costs you $12,618 in interest alone, enough to fully fund an emergency savings account, pay off a credit card, and still have $3,000 left over. That interest did not buy you anything. It did not get you a better car. It did not get you better features. It went to the lender. Every single dollar. And the worst part? Most people finish paying off one car loan and immediately start another one. The cycle never ends because nobody ever shows you these numbers. Until right now. So who profits from all of this? Start with the dealership. According to the National Automobile Dealers Association, the average dealership makes more money from its finance and insurance office than from actually selling cars. Read that again. They make more from your loan than from your car. The finance manager at the dealership often earns a commission on the interest rate they get you to accept. If the bank approves you at 7%, the dealership can mark it up to 9.5% and keep the difference. That markup is called the dealer reserve, and you would never know it happened. Next, the lender. Banks and credit unions earn profit on every single interest payment you make. The longer your loan term, the more interest you pay. That is why 72-month and 84-month loans are everywhere now. They are not there to help you. They are there to maximize what the lender collects. And then there is the trade-in cycle. When your car loses value faster than you pay it off, you end up with negative equity. According to Edmunds, 25.2% of all trade-ins in recent years carried negative equity. The average amount was $6,458. That means 1 in 4 people trading in their car still owe thousands on it. And that leftover balance gets rolled into the next car loan. So now your new loan is even bigger, the interest is even higher, and the cycle starts again. The system was not built to help you own a car. It was built to keep you paying for one. Now here is the objection you are probably thinking. I need a car. I cannot just stop driving. And you are absolutely right. This is not about giving up your car. This is about refusing to pay $12,000 in interest for one. The goal is simple. Break the cycle. And here is how. Step 1, drive your current car longer. Most cars built in the last 10 years can last well past 200,000 miles with basic maintenance. According to IC Cars, the average car on the road in America is now over 12 years old. Your car does not need to be new. It needs to run. If your current car works, keep it 2 more years. Step 2, start a car savings fund today. Take the amount you are currently paying toward your car loan, or the amount you would be paying, and put it in a separate savings account. If that is $500 a month, in 12 months you have $6,000. In 24 months you have $12,000. That is enough to buy a reliable used car in cash. No interest, no loan, no lender profiting from your paycheck. Step 3, when you do buy next, buy used and pay cash. A 3 to 5-year-old car with under 60,000 miles gives you most of the reliability of a new car at 40% to 50% less cost. You skip the steepest depreciation curve, you skip the interest entirely, and you keep every dollar that would have gone to a lender. This is not about sacrifice. This is about strategy. The money you save in interest is money you can actually use to build something. Two people, both earning $55,000 a year, both need a car right now. Person A does what most people do. She finances a $35,000 car at 9.5% interest over 72 months. Her payment is $624 a month. After 5 years, Person A has paid $37,440 toward the car. She still owes about $7,488 on the loan, and her car is now worth roughly $14,000. She has negative equity and 1 more year of payments to go. Person B takes a different path. She drives her current car for 1 more year. During that year, she saves $500 a month. After 12 months, she has $6,000. She adds $4,000 she already had set aside. She buys a reliable $10,000 used car in cash. No loan, no interest, no monthly payment. For the next 4 years, Person B takes that same $624 she would have spent on a car payment and puts it into a high-yield savings account earning 4.5%. After those 4 years of saving $624 a month, Person B has built $32,753 in savings. Let that number sit for a moment. Person A has a car worth $14,000 and still owes money on it. Person B has a paid-off car and $32,753 in the bank. Same income, same starting point, same city. The only difference is what Person B learned. She learned that a car payment is not required. She learned that interest is optional. And she learned it before the system took another $12,000 from her. You are not someone who got tricked. You are someone who was never shown the math. The dealership did not explain the interest. The lender did not warn you about depreciation. Nobody drew out the numbers and said, "Look what this actually costs." But now you have seen it, and you cannot unsee it. This is not your fault. Nobody taught you this. But starting today, you know. And knowing changes everything. Subscribe to She Starts Today, because the system will not teach you this, but we will.